All right, well, thank you all for joining this UVA East Asia Center event. It's a real pleasure for me to welcome Richard Lawrence, the founder and executive chairman of Overlook Investments, one of Asia's most successful and enduring investment firms. Richard's new book, The Model, is a fantastic read filled with lessons from his investing career and experience building Overlook's investment process over more than 3 decades. In the process, he's earned exceptional returns for his investors. In my mind, the significance of today's talk is twofold: timeless and timely lessons for investors. Timeless in that Richard has found creative ways in his career and in the book to apply and adapt the principles of great value investors like Benjamin Graham, Warren Buffett, and John Neff to emerging markets. In the case of Overlook, he's applied those principles to markets across Asia outside Japan. While many investors in these markets trade and market themselves based on their cozy relationships with government officials and corporate executives, Richard and Overlook's success serves as a reminder that good valuation analysis and identifying companies with superior economic characteristics works across all markets and all cycles. It's also timely to have Richard join us in this moment when meme stocks, SPACs, and NFTs garnered the lion's share of public interest in the investment world. Richard's track record and book are a reminder to us all that successful investing over the long run requires hard work, diligence, and patience. He's even been kind enough to teach us his methods in great detail in the book. It reminds us that trees, like companies, don't grow to the moon or to the sky, but they can grow tall and strong if they are well watered and exposed to sunlight. Or in the case of companies, they reinforce their competitive advantages and follow good corporate governance. I hope that my students listening to this talk will absorb some of these lessons and that the broader UVA community will be intrigued enough by this session to pick up a copy of the model. For our audience, please remember to submit your questions for Richard in the Q&A box. I'll collect them and ask at the end of Richard's presentation. Thank you for joining us, Richard. And without further ado, the floor is yours.
Well, thank you, Rick. It's a pleasure to be here, and I greatly appreciate the opportunity to share some of my views on investing in Asia over the last 37 years. I think what I'll do is I have, I think the easiest way to do this, let me just see if I can share my screen with you. And we'll go through this. Basically, there are a couple of parts to the talk today. I'll talk maybe 45 minutes if I can. Then we can have some Q&A. The first part will be a description of the Overlook model, which is really the basis for our work. And the second part, I talk in greater detail about some of the concepts that we've used that I highlighted in the book that my colleagues and I wrote late last year. So to start off with, when I was a rookie on Wall Street and at a really young age and just starting out as a research analyst, my dad sent this over to me and he said, you know, this is what you got to do, Richard, is buy some stocks, wait for them to go up and then sell them. And if they don't go up, don't buy them, you know, from the great Will Rogers. I mean, it's so simple. It was, you know, and the business to dad was very simple. And in some ways, as I get older, the business gets simpler for me. But of course, it's not exactly right what you have to do. So at Overlook, we set up 30 years ago and about 2 months. So we're in our 4th decade now. And I didn't really understand this at the beginning, but I do understand it now that our objective, we had 2 objectives. One was to deliver returns from a specific investment philosophy and to earn these returns for the limited partners. And that's what we call in the business, those are capital weighted returns. Those are IRR calculations. And you can figure out the calculation of that in lots of different ways through the internet. The second is to have a series of business practices that took those returns that the investment philosophy generated and deliver them to the investors. Because I knew way back then, I didn't know the terminology, but I knew that if I didn't deliver returns to the investors, I wasn't going to be in business. And after now 30 years, what we found is that the investment philosophy and all that goes into that work is as important as the business practices and what goes into that. And so I'm going to share this with you a little bit more detail now. So we start out on the investment philosophy with a specific investment philosophy, which is these 4 points were pulled right off a slide that I made, actually it was pre-PowerPoint, that I made 30 years ago, which is invest in superior businesses, management with integrity and know-how to run a public company for and on behalf of all investors, valuation discipline, which we think is absolutely essential. And we've always taken a very long-term investment horizon. And this investment philosophy touches on all the components that you need for stock picking. It's rigid and demanding, yet flexible, and it's proven to be enormously valuable. And we've incorporated it into all aspects of the work. And here we measure this by the time-weighted returns. And so there are a bunch of components of security analysis, and that's what we're really talking about here. You need to bring real discipline in the investment team. And that's partly like our brains. We have a soft side of the brain and a hard side of the brain. The soft side is the culture. It's this idea that we want to invest correctly in Asia. And then we have a whole lot of categories there or concepts there that we use. But it's got to be shared. It's the diversity and cohesion of the investment team is absolutely essential. And so we're pulling the ship in one direction with a common set of components. Then you have the Overlook tools. The tools are we call disciplines, procedures, and processes. These are all the things we use that reside mostly on our computer that we pull out day to day, week to week, month to month, or when bear markets happen. And these tools are all designed to give us insight. And we've now, over the years, we've incorporated most of the tools that we use into a platform that we call the Tower, which is composed of the companies that at the right valuation, we'd be happy to own. So we work at this very seriously, and it takes a lot of work and effort to get the inputs correct that go into the Tower. And then you have to have experienced investment management. You got to know how to run the components that really impact the running of the portfolio. Well, first of all, the most important one, of course, is managing for bear markets. And it's even funny to talk about bear markets today because we haven't had one in so long, right? Seems like a far off risk, right? But bear markets roll through town with regularity, okay? And if you're in the investment business for any period of time, you'll go through 1, 2, possibly 3 really big bear markets. And during those times, you cannot swing and miss. And so what the key concept here is to prepare today for the bear market to start tomorrow, or to think about it as that you cannot predict bear markets. Everybody loves to predict bear markets, but it's not the prediction business because you can't do that accurately. But you can predict, but you can prepare, right? This is having stress testing your portfolio, not having a lot of debt, not having a lot of cyclical companies. It's all in the blocking and tackling. Then we add a component to our investment management, which we call modern finance technology, which helps superior businesses address what we call blind spots. And the blind spots usually surround corporate governance or capital management. And those are topics that are big umbrellas that we talk to managements privately and confidentially about their blind spots. We're trying to make them even better as a public company. And this has been enormously helpful, but no one knows we do it because we do it privately and confidentially, which is an essential part of it in Asia. Then next, ESG. ESG has become a bit of a buzzword in today's world, but we've been working on this for 30 years. We worked on governance. 25 years, I started going into factories that I didn't want my kids working in. And over 15 years, I was fortunate to know Jeremy Grantham, and Jeremy has opened my eyes to the threat of climate change. ESG is not something that we had to force into Overlook. It is a natural component of our beliefs and our culture. And so it's an easy add-on for us because we take it so seriously. And as we look forward, our view is that the climate is a particularly troubling challenge that all our companies are going to really have to fight to address. And we've been very involved in pushing our companies in the right direction there. We tell them that, look, they have to prove to us that they're part of the solution, or they become what we call part of the problem. And if you're part of the problem, you're probably not going to stick around in our portfolio very long. And then another one is the art of selling. Selling is much harder than buying. And we all intrinsically know that, right? I encourage you to read James Squire's chapter in the model. It is by far, without a doubt, the best chapter on how to sell securities that I've ever read. And it builds on a lot of the initial concepts that I was certainly involved with, but it's a fantastic chapter. So if you take those three things, the investment philosophy, really disciplined security analysis, and disciplined investment management, what that does is it pushes your portfolio to the top of what we call the Overlook pyramid. And that's where superior businesses reside. At the bottom are the low return on equity, high debt, high cyclical businesses. We generally, when we invest in those, they end up usually being mistakes. But if you can push your portfolio to the top of the pyramid and keep it there, and keep it there for 3, 5, 10, 7 years, keep it there for an extended period of time, that is what we call the path to performance. And that is, at its essence, that is the core concept that has led to the delivery of, or to the creation of time-weighted returns over 30 years at Overlook. Now, there are 3 caveats you got to take into account. Number one, you got to be able to do really good security analysis. You got to be into it. You know, it's got to be a passion. Secondly, you cannot badly overpay. We've all overpaid for securities in our lives, but when you badly overpay, it has the effect of pulling the portfolio down in the pyramid. And as you go lower in the pyramid, your ability to perform diminishes. And then lastly, you have to be very careful about size. Size is the enemy of non-correlated gains. If your portfolio is so big that you are the pyramid, you're not going to outperform it. So that's pretty simple. And then you have to, you take that performance that the investment philosophy is given, and now you've got to deliver it to the limited partners or your investors. There's been lots of documentation about it. Jack Bogle's written about it. My friend Ilya Dikev at Emory has talked about it, where there's a big discount between what the fund produces in terms of returns and what the investors earn. And I've seen research that's as high as 7.5 percentage points per year. So if the fund tells you they're going to give 10% returns, the numbers over time suggest they're actually delivering 2.5% because of failed business practices. And so when investors come and talk to me, they're talking 90% of the time on the investment philosophy. They should be talking 50% on the business practices and 50% on the investments. It's absolutely essential. So I'll share 5 with you here very quickly. The legal cap on subscription is by far the hero of the story. It limits the inflow of money. Capital typically comes into funds at the tops of bear markets and then leaves at the bottom of bear markets. And having the cap on subscription has largely reduced the risk of that. And that's an essential component of it. But we also have one fund, no side accounts, no special deals. We have a limited portfolio of 20 to 22 holdings. We outlaw greed legally. We cut our fees, no proprietary trading, no employee trading, no soft dollar brokerage. I'm trying to take, by legalizing outlawing these practices legally, I'm just taking the devil out of Richard Lawrence by saying it's not legal for us. We believe in building, of course, this investment community. And part of the reason I do all these things is to build that community. Because I need long-term capital if I'm going to be a long-term investor. We embrace diversity. We're fortunate. Hong Kong is one of the few places in the world where you can really get diversity. So we're half male, half female, half Asian, half Western. We have a median age of 45 years old. Anybody who's worked in diverse organizations understands that this adds complexity, but it also adds richness, and we're very dedicated to it. And then we've structured the ownership for long duration. And this is particularly a problem that the investment management industry has struggled with for a long period of time. And so, again, go back, if you can get the investment philosophy and combine it with business practices, that is what creates success. And if you look at our returns here over 30 years, you see the time-weighted returns, the capital-weighted returns are almost identical, and they're identical over 1, 3, 5, 10, 15, 20, 25, and 30 years. We've outperformed our benchmark. So the time-weighted returns have outperformed our benchmark by 6.9 percentage points per year for 30 years. And we've generated over $7 billion of gains. And so we believe that just the continued execution of our what we call the Overlook model is what is absolutely the essential challenge of our business. So I'm going to switch gears here a little bit, and we'll talk about the model. I wrote this to celebrate our 30th anniversary with all our limited partners and our friends and family. Rick was nice enough to, he somehow finagled a copy of it, and was nice enough to invite me here today. And but this is sort of some of the concepts that we spoke about. And first of all, I like valuations. I'm a bit mathematical, and valuations are very counter to investing, which is certainly an art. But valuations, in some cases, are really helpful in providing us benchmarks. You know, they send these signals, right? Is the traffic light green, yellow, or red? You know, and so great equations incorporate critical components. And so I wanted to share some with you. The hero of this story, of course, is a man by the name of Donaldson Brown. He was an executive with the Eli DuPont company in the early 1900s, and he was actually an explosive salesman. And in 1912, he invented the DuPont model at age 27. The DuPont model below is really we all know the value of return on equity, but it delved into how do you get return on equity? What is good return on equity? What's bad return on equity? And it's been so fundamentally important. It's by far the greatest equation that's ever been created in the financial markets. And here are just parts of it. You know, when you go in and look at asset turnover, well, you can look at total asset turnover, you can look at turnover receivables or inventory or whatever. It's just so powerful and fundamental to what we do. This is the first depiction I've ever seen of Donaldson Brown. We dug it up, which is a great thing about the internet, but he's the hero, really. And I also came across in readings through my lifetime that Ben Graham had an equation, John Neff had an equation, and so I said, I created an equation, and I created this in 1982. I was looking at specialty retailers. And it really carries forward and is of enormous value to us at Overlook. And recently I found that Ben Graham had updated his equation in the Intelligent Investor. So I'm sorry, hold on. Sorry, I got it. That's got it. I'm at my mother's house, so apologies on that. So we updated our original equation, but it combines growth and profitability and valuation. And to me, those are all items that are connected at the hip. But as I wrote the book, I then asked one of my colleagues, I said, here's the Overlook model. Can you make an equation for me? And we went back and forth on some equations. And in the book, you'll see you can actually, if you're a good mathematician, you can actually read this. The investment philosophy is getting to the top of the pyramid with dependence upon valuation and size, and that will lead to returns over the benchmark over 3, 5, and 10 years, and on down you go. And I think rather than buying an NFT, I think I want to sell this as an NFT, but it really more of a joke than anything, really. So I talked a little bit about modern finance technology, and here's the actual definition. It's a provision of private and confidential advice to chairmen and CEOs on issues of corporate governance and capital management with an objective of building better public companies. This is you find when you engage very seriously in a small gathering of 2, 3 people with a chairman or CEO, you see whether they're the real McCoy or whether they're not, and they're going to end up in our hall of shame. But I really love this because when I see a guy who will really work with us, that is, you know, the guy you can extend the duration that you're going to own it. And the classic example of this is I I called out Morris Chang, who was the founder of TSMC in Taiwan 18 years ago. And Morris called me up at home and said, work with me, Richard. I get what you're getting at. Work with me. And 20 years later, or 18 years later, we still have TSMC as one of our largest positions and have been privileged to be an investor for all those years in TSMC. And if there's ever a real McCoy in Asia, it's Morris Chang. But corporations have blind spots. And there you see the structure of Samsung in Korea. And that is the result of blind spot. And, everyone tries to figure out that this or that, and it's just a mishmash. And there's so many conflicts of interest there on the left, you can't even begin to count them. Contrast that to Link Reed in Hong Kong, which was very simple business, run incredibly well with enormous foresight and planning and just amazing investors. And they do not have a blind spot, whereas I think Samsung has proven they certainly do, and conflicts of interest. But fund managers, and I talked a little bit about this, fund managers also have blind spots. And this is the difference between the time and capital weighted returns. You should never invest in a fund where you don't know what the time and capital weighted returns are over 1, 3, 5, 10 years, and what that discount is. Because if you are investing in a fund and you've done well, but everybody else who invested in the fund has done very poorly, in the next bear market, there's going to be mass redemptions, and you're going to end up holding the cost of that. And you see at the bottom that there with us, the time and capital weighted returns have been almost identical over all those periods of time. And as a result of purposeful business practices. So every fund manager can do it. And yet this discount is pervasive throughout the industry. And the more famous the person's name, the more likely they're going to have a bigger discount. And so you really need to be aware of that. ESG, we talked about it, that it comes naturally to us, but there's a component of ESG you have to understand, is it has to be authentic. And so, for example, on social, if you take that, when I go in and criticize the social practices of a company, well, I have to have the right social practices within my business, and things like diversity are examples of that. On the environment, well, Overlook has been carbon neutral now for 12 years, going on 13 years now. We've outlawed businesses for environmental reasons for now 9 years. And so we're practicing this. We're not just telling our companies. And so our policies are very set forth in quite a lot of detail that we share with the CEO and chairman in a private and confidential letter that we write to them every year. And there's 3 parts to it. And I'll briefly share these with you. There's awareness and goals. So I want to see that CEO and that chairman is really aware of the significance of climate change on his business. I want disclosure and credibility. I want disclosure under CDP, TCFD. I want the numbers based on evidence, not estimates. I want scope 1, 2, and 3. So many companies don't report scope 3. Why not? Because it's a huge number and they don't want you to see it. So disclosure and credibility is absolutely essential. And then we want leadership, and we want to see signs of real engagement. And the compensation of the CEO has to be tied to emissions. And it's not tied with a chief sustainability officer who the CEO would meet once a month. It's crazy. And so what we do when we write these letters is we set forth our policy. We set forth specific analysis of how we see the companies and what they're specifically doing. We give the company a grade. And for the last 3 years, over 40% of our companies are getting failing grades. And then we give them a list of specific actions that we feel they should be taking on the environment. And this is done more to improve the engagement with our companies than almost anything else we've done. We're all looking, executives and all people around the world are looking, what are the answers to climate change, right? And on the right-hand side was a kind of a questionnaire that we get and the companies get. And the companies always complain to us about these things, because this was 9 pages of ticking the boxes. And I can tell you the CEO does not do that, but the CEO is reading my letters. And so it's just a whole different way of engaging. And I think that what this does is, again, who's the real McCoy, who's the part of the solution, who's part of the problem. And you can see here, this is one of our largest holdings, China Yangtze Power. It's the largest renewable energy company in the world and the lowest cost electricity producer in China. And they're against a couple of coal and energy companies. And what this climate problem does, it creates opportunities for bifurcation. And so I think it not only is it the right thing for us to do as Overlook as citizens of the planet, but it's always a smart business to do it and do it correctly. So we are believers in long-term bifurcation of successful. So here is just reference to James's chapter. And I'll just give you a couple of summaries on this thing. One is the core of this thing is that the quality of the business drives the duration of the holding period. So at the bottom right, we have a tier 3 business, which would be a low quality business, largely things that we call mistakes. And what it shows you is that time works against you, because really the business might do well for a period of time if you bought it right, but over long term, it's not going anywhere. And so time works against you, whereas on the right, with what we call a tier 1 business, time works for you. And when time works for you, the duration really becomes infinity. And it takes a lot for us to get our TSMC out of our portfolio. We'll rebalance it for risk purposes, but to get it out, it's really hard because we're so clear that it's one of the leading tier 1 businesses in the world. I think this structure, and there's a lot more to it in the chapter with different ways that we sell securities, but I think the core concept that's really valuable for all practitioners is duration should drive your expectation on how long you're going to own a stock. The other thing is long-term valuations and long-term numbers tell a story for us. Okay, and so this is a chart that we've been making since 1996. So it goes back. I guess there are people on this call that weren't even born in 1996, and you can see in the early years, Asia really didn't have its act together. And right at the beginning, we went through the Asian crisis. But you see, even today, now it's telling us that Asia's not a bargain. But over the last 18 semi-annual periods where we've calculated our numbers very consistently for a long time, 8 have higher PEs, 8 are around where we are now, and 2 have lower. And so I don't think our portfolio is horribly valued. It could go down another 15 or 20%, but at some point, valuations do put floors under portfolios and under markets. And I think if we can keep pushing our portfolio forward, trying to add in companies, tier 1 businesses that have lower PEs than our existing average dollar-weighted average, that we can lower this and build more defense into the portfolio. So we're big believers in these kinds of very consistently calculated numbers, and we'd carry this on normalized growth, EPS over the last 3 years, 2 years forward, returns on equity, operating returns, net debt to equity ratios, et cetera, et cetera. This, it's not hard to put this data together, and over time it just gets more and more valuable. So now we'll talk a little bit about bear markets. I was fortunate. I worked with a guy by the name of Jonathan Bush in New York. I was the head of the research department at a very junior age. I think John probably figured that my dad was a money manager, and my dad would help keep me out of trouble, and John would help keep me out of trouble. And John and my dad were both exceptional investors in the 60s and 70s of that generation and into the 80s. And in 1973-74, which was their equivalent of 97, 98 in Asia, the really big bear market, the Nifty 50 went down over 90%. In December, as a Christmas gift in 1974, John sent this. This was a comic out of the New Yorker. He sent it out, and he had literally crucified all his investors, and then had the style and the panache to send this out to everybody. And I assume people didn't think it was funny at the time, but it's kind of a classic of how all investors feel in bear markets. And I wrote about my time during 97, 98 in the book, and how I just had these sick feelings calling my investors in the United States, telling them that I was down another 10% for the 5th straight month. And, and I felt like hiding under my desk. And here, the office manager, which probably doesn't exist anymore, is telling the irate client that he'll be sorry he missed you. But I can assure you at the time that we all considered a stock with strong growth possibilities. And of course, this was the wipeout of the Nifty 50. And we could change a little bit the last couple of words to describe 97, 98 or 07, 08. And when the next big bear market rolls through, you'll also see it. Bear markets are a fundamental part of our business. And if you can't survive them, don't be in them. So the first lesson is, and I've written lessons of a bear market in the book, the first lesson is you got to survive. If you don't survive, you're out. It's like losing the last chip in a casino. You're gone. You can't ever get back. Prepare, don't predict bear markets. We know bear markets hurt, and I'll give you some data on that. You can't question your investment philosophy. The worst thing you could do at the bottom of bear market is change your investment philosophy. And that's the insanity squared. Anytime changing your investment philosophy from growth to value or technology, all that stuff is just crazy. And one of the things that's very consistently emerges from bear markets is new leaders. Bear markets are periods of change of leadership. And this is really fundamental. It's a really important point. And typically in bear markets, what we find is a normal year where we have 4 or 5 stocks turn over in our portfolio of 20 to 22. In bear markets, you'll have 8 or 9 turnover because we are understanding that there is a real fundamental change of leadership. And if you can do this, outperformance lasts. And I can show you some evidence of that, which we can buy good stocks in 21 or 22, but we're never going to generate the IRRs that we can earn by investing in those same stocks during a bear market. And it's just so fundamentally important. So the first thing we said, bear markets hurt. Here are the average declines over the last 100 years of bear markets. Okay, so it looked like you can expect a really big bear market. It's going to take you down 35, 40%. Okay, bigger ones come along. And this is what's hard, you never know when to end. You can't predict the end. You got to invest right through bear markets. We have a saying at Overlook, you buy early and often, because we can't predict the bottom. And in fact, most of the time at the bottom, I'm so pissed off that we don't actually buy very much. But the other thing, even more important for all of us, because bear markets are these psychological challenges. They physically exhaust you. They mentally exhaust you. Bear markets actually end. Bear markets really adjust very quickly. And it's an important thing to remember that these things don't go on forever. Because they certainly feel, when you're in it, they certainly feel like they are going to go literally on for the rest of your life. And bear markets hurt when you make a mistake. This was a Thai property composite index. In dollars in 97, 98. And it went down 99.3%. And if you want to know what 99.3% is you have a stock and it goes down 80%. Then it goes down another 80%. And then it goes down another 80%. And then you get to 99.3%. That was, you could have, made a mistake on this, but if you made a really bad mistake at 2,500, you really crucified. And that's where we're talking about. And I got lots of stories of a property in Thailand before 97, 98, right? But it shouldn't have been hard for thinking investors to have avoided this wipeout. Second thing, I share you a few numbers. This was numbers off of our portfolio at the bottom of 97, 98 and the bottom of 07, 08. their numbers to look at are 97, 98. We went to 0.7% of book value. We went to 4.8 times current year earnings. That's what we were down in dollars. We were down 65%. That's what a really crunching bear market does. But of course, that's the bad news. The good news is we were able to buy stuff that was just incredible. And similar in 07, 08, were also really, really good values and change of leadership. So I went through and I just note down a few of the companies that we grabbed at various times, which was clearly the result of change of leadership. And all of these were fantastic companies. If you take an example of YU Auto Parts, this was after a 7-year bear market in the A shares in China, where we were getting this thing at mid-single-digit PEs. And I'm telling you, no one wanted to buy A shares then. The international investors who had gotten quotas were happy to lease their quotas to us so we could load the boat with A shares. And YU, it was the change of leadership. And I can point to an example I gave in the book, or I think I gave it in the book, whereas I was in a meeting in Shanghai with the CFO and the IR, and there was a guy at the end of the table, down at the other end of the table, and I kind of whispered to my colleague and said, "Who's that guy?" And she said, "He's the party guy, taking notes." And so I got a little pissed off, as I might, during the meeting, and I said, well, I said to the CFO, I said, "Who's looking after my interests?" I kind of put my New York accent on. And he says, "Oh, well, the independent directors are." And I go, "Oh, yeah, really? Really? Yeah." He goes, "Would you like to meet him?" I said, "Yeah, I think I would like to meet him." A couple of weeks later, I came up and met the independent directors. And it was so fundamentally changed that this was a change of leadership event, that these guys with no role models in A shares, no role models at all, they were striving to figure out how to run a public company. And so the new leaders and these types of events, which you will come across in your career, they are so powerful and lead to big gains. Now, I said that when you invest in a bear market, you get 3 to 4 to 5 years of outperformance. And these are not small numbers. These were outperforming after 97, 98. Now, we came right out of 97, 98 into an internet bubble. And you can see in 99, I underperformed yet again. That was kicking a dog while he's down with a broken leg. He got kicked again, But as soon as the internet bubble broke, change of leadership happened, and we were outperforming by over 20% percentage points a year, which is an incredible number, even with a small fund. And then after 07, 08, the same thing. And this is really the power of it. And you can see over long periods of times, we've outperformed by almost 7 percentage points, but the bear markets really help. And so I've talked a lot about the importance of the Overlook model, that we start every meeting with it. I wrote the book partly for my investors, but partly for my colleagues, my 12 people who work with me, to just reinforce how important it is. And over the years, I've learned that not only does Overlook have a model, but companies have models. And when you find companies that really have a model, it's incredibly powerful, because everybody in the organization knows where they're going. And so I came across TSMC 20 years ago, and I remember the very first meeting, they said, "We don't compete with our customers." And if you walk into Hsinchu for your first meeting with TSMC, someone will sit you down and they'll say, "We don't compete with our customers." It's just so fundamentally important. Samsung, Intel, massively compete with their customers. So if you have something really great in IP, would you rather take it to Hsinchu in Taiwan, or would you rather take it to Seoul, South Korea, where Samsung is potentially a competitor, and you got to expose that IP to them? They spread the fabs over many customers. They treat everybody the same. I love the comment that Morris Chang learned in his early days, that the small company that just shows up with no money but a good idea is going to grow into the next behemoth. And he treats everybody the same. At Overlook, we treat everybody the same. It's just the way to do it. Cutting edge technology, they just have worn down Intel and Samsung with just the compounding of hard work and diligent effort. And they adhere to this very sophisticated financial model where everything gets priced correctly. And so for the last 10 years, I've been saying that TSMC is the finest public company in Asia. And it's largely on the back of the model. And it's an example of, the importance that I ascribe to this stuff. So their definitions, I think we can stop sharing the screen, and I'm happy to talk about any other subject matter that anyone wants to. It was pretty close on 45 minutes, Rick.
Great. Thank you so much, Richard. That was a truly a tour de force of what Overlook does and the model that you've put together. So I'll just remind the audience that the Q&A is open, so please submit the questions that you have. I just wanted to start, Richard, with a couple that I have for you. One of the things about Overlook is that you all are Asia ex Japan, so that you have a focus in terms of region. And I've always found that there are two different types of ways investors approach geography. They either have an approach where they say, we're really, I'm a US investor and the value investing principles only apply in Western developed markets, and so I'll stick to those markets. Or you have another vein of investors who take the approach of, I understand the industry, particularly technology investors tend to have this outlook. I understand global technology, and I'll just be able to apply all of the principles of what works for one technology company in the US to other markets, and therefore I'm now an expert on China technology or Southeast Asia technology. So I wonder if I'd like to get your take on those two competing schools of thought and where you come down on geography versus industry when you decide what your scope of investment should be.
Well, David Swensen penned it that he wanted inefficiency. David ran the Yale Endowment for years, for those who don't know who he is. His whole deal was looking for markets that were inefficient. And Asia's been massively inefficient for a long period of time. And it started in Hong Kong and Southeast Asia, and then it's just rolled everywhere else, and even A-shares, there's massive inefficiencies in it as people chase dreams rather than chasing fundamentals. So I've always embraced bad accounting. I've always embraced bad corporate governance. I've always embraced predatory behavior by CEOs, because generally I can avoid those more than the next guy. It's not that I haven't been caught, and I mentioned a bunch of names in my book about people who severely disappointed me, but all of that inefficiency is partly why American investors would say, oh, value investing doesn't work in Asia. Value investing works. You just got to really be there and understand the culture and understand and have serious conversations with companies. I've showed up at so many companies where I'm the first redhead from New York to walk into their office, and I'm a little pushy in my questions and stuff. They don't know how to deal with me, and I've gotten better on cultural things, and they've gotten better, and figuring out those relationships and stuff is really one of the great challenges, right? So I think investing is fun, and investing is investing. Asian numbers are bad, and we've beaten them handily, but part of that is MSCI. MSCI is a very failed model, I think, and they're not serving investors well. And it's happened while this huge wave of indexing has gone on. And we've seen time and time again, they put the wrong stock in at the peak valuation, and it penalizes everybody. So they're not helping anybody. And so I don't even know, if you ask me what the 10 biggest stocks in the MSCI are, I don't even know it. And I outlaw my colleagues from knowing it, because I don't want to be impacted by that. I don't want to be adjusted by it. I don't want to know it. We make our own decisions for our own reasons. So inefficiencies and all that, I'm fine with. Now, for people to take technology or some industry specific, yeah, you can do that. But maybe you think you got smart by investing in Tencent, when actually, in a lot of ways, Tencent was moving beyond what Facebook is in the United States. And so I mean, it's fine. I mean, it's certainly better so you have at least some expertise. The trouble is when you're in a specific industry, you tend to be always in that industry. And the industry, there are times when you just got to get out of certain industries. We owned a lot of consumer stocks before 07, 08 hit in Asia, and they got up in some cases up to 30, 35 times earnings. And we don't know how to make money from 35 to 45. We really don't. And we sold them all. And we were happy to sell them. Because now, if you're in and just have consumer stocks, you don't sell them. And that becomes a problem. At the end of the day, everything has to be for sale. So I think there are differences, and people call me a value investor. I certainly believe in value, man. Who doesn't want to buy value, right? But I also want growth. And so I think growth and value are joined at the hip. And so we have stocks in our portfolio that you would say is a classic growth stock. I mean, TSMC has to be. It's got one of the great growth track records in the world over the last 20 years, right? But we have other stocks like China Yangtze Power, which has become the largest renewable energy company, that you'd look at and say, this is really a value stock. And what it is it's the question, Rick, is what do you pay and what do you get? And I think that's a much more important question to answer than being just narrowly focused.
Yeah, I think those are great points, and I really appreciated you highlighting some of the flaws in the MSCI indexing, because so many pension funds and other people's savings are tied to global exposure through the MSCI, and the question is really, do they know what they're buying, and are they being led astray by this attempt at global diversification?
Now, I would tell you, Rick, I would tell you that I've outperformed MSCI by 6.9 percentage points because strictly on the genius of Richard Lawrence. The fact of the matter is that's probably not the case. We've been very disciplined, very good, but MSCI is doing a lot of damage.
Yep. So I have one more question before I turn over the audience questions. One of the things that we talk about in my global marketing class is the power of names to create norms. And we always give the classic example of designated driver being a sort of a positive term as opposed to saying somebody's the sober person at the party, right? It creates a positive norm around that, using that naming mechanism. And I thought in your book and in what Overlook does as its business practices, the concept of modern finance technology is another instance of names creating norms. Basically, I would compare it to an activist playbook or in the US. And I just really found that really powerful. And I'd love just to hear a little bit more about maybe some of your experiences talking with companies about modern finance technology, which to me sounds like something that who could be against being a company with modern finance technology.
Right. And it was a moment of genius to come up with a name, because I really struggled to get executives to listen to me. And, when someone crosses their arms and kind of sits back, I was getting a lot of that. And so I invented modern finance technology. Everyone wants to be modern. Everyone wants technology, and the CEOs know they don't know enough about finance, so it was one of those things that kind of does create the CEO an opportunity to lean in and engage. And yet when we talk about issues of corporate governance and capital management, that is a really big umbrella. I can talk about just about anything, and I don't tell people how to run their factories, but on broadly speaking, issues of corporate governance and capital management take a lot into subject matters that you can very legitimately talk about. And he's accepted that we're going to talk about those things, because we tell him, here's the definition. This is the way we operate. Now, there are a couple of tricks to it. One is we won't talk about this with an executive for over a year, that we have to own the stock for at least a year before we go in. I have no preconceived idea that I am right on things unless I've been in it for a long time and really thought about it. So the longer you're in, the better when you bring this stuff up. The more you've really engaged with management to build a real relationship. Because ideally, when I sit down with that chief executive to have what could be a hard conversation, that he has already understood that Overlook's a bit different from Fidelity. You know, that we ask different questions, we're more engaged. I have a rule that after every visit, we write a thank you letter. Why do I do that? It doesn't take much, but it's another exchange that he got from Overlook that he didn't get from Fidelity. And so you're building bridges, and if you can build as many bridges as you can before you bring up a difficult subject, he's much more inclined to listen. The other key is to do it in small group. So I say one-on-one, you've got a good chance of success. 2-on-2, less, you got 4 people on his side in the meeting, you're not going to achieve anything. And it's important that you try to stage manage these meetings where you can have an open and honest private conversation with the guy. And hopefully, you know, it should not be your first meeting with the person. You know, and it takes people a while. It takes people a while to understand that I'm a New Yorker or a white man, I'm a Caucasian man from the United States, and particularly with red hair, they don't see a lot of that. And what am I doing advising Asians? And you have to kind of, you have to build that relationship. But if you do, I think your analogy, designated driver, is great. I'm going to steal that one from you if I can. Because literally, I knew it worked when there was one of the guys who was in our Hall of Fame, a guy by the name of Ming Chang, who runs a great company in Taiwan called Chroma ATE. And Ming and his partner Leo had failed MFT before 97, 98. After 97, 98, I got a call one afternoon in Hong Kong, and Ming came on and says, Richard, the next time you're up in Taiwan, can you come by? We'd like to talk about this MFT thing you talk about. And he was delivering back to me, you know, and wanted to learn. And there was a guy that went on, paid massive dividends, grown terrifically. It's been a huge success. So.
Great. All right, I'm going to turn it over to some of the audience questions. We've got some great ones coming in. Please keep them coming. First question, can you talk a little bit about whether anyone can execute the model, or if it takes a certain type of personality or background in order to be able to execute the investment style that Overlook pursues?
I know anybody can do it, anybody, you know, but people have been coming to me for 30 years wanting introductions to investors. And I tell them, put a legal cap in your document and bring the legal documents back to me, and then I can help you. No one's ever come back. No one. And so everybody can do it, but the big challenge is really greed. You know, you when you get, you know, whatever millions under management, you want more and more, and you want more vehicles. And, you know, then it becomes a business rather than a process of managing money. It becomes a business of the management of money, which is really about accumulation of assets. And so you somehow have to figure out mentally how you're going to repress your greed.
Great, thank you. We have a couple questions about your approach to ESG, which I think is pretty interesting vis-a-vis a lot of other asset managers. One question, the first question was, when you talk about your values in the context of ESG, you mentioned that you can't criticize aspects of a business where your own organization is lacking. Could you detail some of the best practice for asset managers and other industries and how that plays a role in your approach?
Yeah, I mean, I think the fact that we're carbon neutral for 12 years, you know, that we've outlawed industries every year. You know, the early years of outlawing an industry was a big fight with my partners. we don't fight that anymore. We're really well educated. I think the ownership transition at Overlook is a corporate governance issue. And I think, it allows me to talk to his chief executive about corporate governance in a way that is more authentic, because I believe in it myself. The social stuff, I mean, we don't invest in companies if I'm not willing to go work in that factory, and it becomes, the diversity issue is another example of it, where we've really worked not only to get half male, half female, but half Western, half Asian, but we've also worked really hard to get the age difference correct. I mean, 3 or 4 years ago, there was a guy who was a wonderful candidate, but he was the wrong age. And he just was the wrong age. I didn't want that age. And so we took another guy who was also a terrific investor, but younger. We had to do more training on him. I'm a big believer. You can read the chapter where we outline both the internal and external steps that we've taken. But we're just trying to do the right thing. We're just trying. If you really want the answer to these kinds of questions, really study where we stand on climate change today. I spent a lot of time on climate. It's not a pretty picture. Okay, governments will say they're going to have a 30% reduction in methane in 10 years. I can tell you, by knowing the sources of methane, that is not easy. And yet they just kind of roll it out there that it's magically going to happen. And so when you think about our world, outlawing industries is very simple. And a lot of these steps, being carbon neutral and being aware of and educated on climate change, is very, very straightforward. It's not a hard thing to fight. But I think all of us need to be really engaged in part of the solution, part of the problem analysis with our companies going forward, because there are issues. I'm just now, from what I've learned, I've divested from food companies, or in certain cases, a lot of dairy and cattle, beef companies. And I think there's going to be another wave of that coming, and there should be. So the more, like any subject, the more educated you are, it's very clear that education leads to lessons on how you invest.
We have another question on ESG practices. And by the way, I thought your answer on succession and setting an example there is also incredibly important, given that there's so many Asian family businesses that are going through that right now. Yeah. Question about ESG. One of the things we're seeing in the US is that there are a lot of endowments and other organizations that are pushing for asset managers to focus more on ESG as part of their strategy and approach. How do you see that difference evolving between the US and Asia?
Well, Asians are horribly behind. And you cannot fix climate change here in the US and Europe without fixing it in Brazil, India, Indonesia, and China. You just can't. The numbers don't work. So we are pushing our companies hard. We do it privately and confidentially. And so there's a limit to Richard Lawrence's power. But Asia is really badly behind. And if we just import MSCI with their ESG designations, that's not helping anything. So I think, one of the great risks that we have with indexation, and when I went into the business in 1981, we didn't have index funds. We had mutual funds, but we didn't have index funds. With this massive growth of index funds, so many people are not thinking about what stocks they own. They're relying on MSCI, and there aren't enough investors out there really pushing companies to move on really important issues, so because the index guys don't do it. I mean, BlackRock, say what you want, but please, BlackRock's had the worst record on climate change voting in the United States. And now Larry Fink says, oh, he's the most sustainable investor. Well, if Larry Fink wanted to divest out of fossil fuels, it would take him several decades of work to get fossil fuels out of all of his index funds and all of his accounts. And so there's ESG is getting abused because it's a way to accumulate assets. ESG at Overlook is a way that we're finding out who the new leaders are going to be and where we as citizens of the world should invest our capital. And it's all about sustainability, because I know there are lots of industries that are not sustainable, fundamentally cannot be sustainable. When that tipping point comes, you don't know, right? But we've seen it come in coal, where don't tell me, coal is going to be around in 20 years, because it's not. So you hit tipping points, and that's why you've got to be very skeptical about what fossil fuel companies are telling you.
Great, thank you for that. We have another question about valuation sensitivity. How do you think about errors of omission driven by valuation sensitivity? i.e., are there cases where you will adjust your framework and pay more to account for an exceptional business or management team?
No, we don't do that very well. We really don't. We're just so fundamentally grounded that businesses that make no profit, it's fine while it's all going. It's the second it turns, and you reference SPACs and a lot of these no-profit businesses, it's fine, and all of a sudden one day it's not. And Murphy's Law has told me that usually the day after I buy it is the day that the tipping point came on it. And so we just prefer not to own them. Now, that is part of preparation for a bear market, right? So there are weaknesses to this. And so we're not gonna, we probably don't outperform in these ripping bull markets, right? But it's amazing how fads go, and then one day you just wake up and they don't. And so it's tough. Everybody's enjoying the party and you're not. That's hard on people, right? So you've got to train your investor group, to really understand fundamentally what it is you do and what you can do and what you can't do. And if you want me to be the ripping bull market investor in Asia, you're probably with the wrong guy.
Yeah, and there are also plenty of folks out there selling that pitch, and so better not to swing at every pitch that comes in.
Right.
Another question about growth. What kinds of characteristics make for good growth when you're investing in a company? In addition, what factors should you be wary of which make returns hard to realize?
Well, it's kind of, if you go back to very simply return on equity. Return on equity, when a company has a fast asset turn that you feel is sustainable, that drives to good return on equity. If you have a company with a lot of leverage, that can lead to a good return on equity, but for all the wrong reasons, right? So I like return on equity, the DuPont model and all of its ancestors. That's important. We have always felt that the number one characteristic you want in a corporation is pricing power. Pricing power works in good times and bad. Pricing power works at times like this where we have inflation, and it also works well in deflationary times. And so you all got to think, how do we measure pricing power? And I don't like to give it away, because I think fundamentally the process of thinking through how you measure pricing power leads you to have confidence that that is really a valuable way to get insights into companies. Because inevitably, as a long-term investor, you're going to go through periods of growth, periods of recessions, period of inflation, period of deflation. And what hangs around everywhere is pricing power. And you can look at TSMC, or you can look at China Yangtze Power, which are two companies I've talked about. Both of those are gold standards on pricing power. And so you can try to figure it out from there. But I think I'm not going to answer the puzzle for you. It's more important that you actually think it through yourself, where the pricing decision happens at corporations and how that's reflected on income statements. So again, I think there's also another rule of thumb, which is companies can self-finance a rate of growth equal to their return on equity. Now, I've talked a lot about return on equity, and it's distorted by lots of accounting things. And so we talk about operating return at Overlook, which is EBIT over the operating net assets of the business, right? So it's a more pure definition of the profitability of a business. But basically, companies have a rate of, they require a rate of profitability in order to self-finance their growth. Now, when you can't self-finance your growth, then you're into this capital management issue. And times when I get hurt is usually at times of capital raising, where there's a conflict between the management and shareholders. And so I really encourage everyone to think about self-finance growth rather than rapid growth.
Great. Obviously makes everything a much more sustainable process. So it makes a lot of sense. We have another question about the role of macroeconomics in your framework, and whether you are purely bottoms up. I know there's a quote in the book where you take issue with Warren Buffett's claim that you can just ignore macroeconomics, and the questioner asks, macroeconomics does play a bigger role outside of the U.S. In generating returns from their perspective. So love to get your thoughts on the role of macro in Overlook's investment approach.
Yeah, there are a couple of, when you talk internationally, they cannot issue large amounts of debt in their own currency, right? They're relying on dollars. The US can issue debt ad infinitum because they are on the dollar standard. That fundamentally is an enormous economic advantage for the United States. Thailand does not have that. Okay, so where you see this problem that's about to blow up is in the current account. Current account, companies running current account deficits are running funding deficits, and they're filling that funding gap with dollars, and that lasts as long as the currency holds. And the day you lose confidence, the currency goes, the dollar goes up multiple times, and you run into a situation what happened in Asia in 97, 98. So the current accounts really matter. They don't matter to the United States, but they matter to everyone else. And so you really got to keep an eye on that. We also look, there are 3 or 4 things that really are corrosive. So current accounts, top of the list. Fast credit growth is another. Banks, in my view, can grow credit properly at about 7-8%. Anything in excess to that, the CEO doesn't know where the money is. He doesn't know what risks he's taking. So, wherever you see fast credit growth, you got to be very, very concerned and distance yourself from that. Then things like levels of inflation, levels of government deficits, things like that, the inflation rates, which we now have to track really, really carefully with. Thankfully, in Asia in 97, 98, the entire region was flashing red, get out of Dodge. And Warren Buffett said, you don't have to worry about that, Richard. Well, I knew I'm an economics major. I knew they were bad. And he said, oh, you don't have to worry about that. So I didn't. And then I got steamrolled. I don't ignore them since, but excuse me. Thankfully, Asia has run current account surpluses. And we have a few macroeconomic numbers that flash red to me now, but for the most part, we're in really good shape. But yeah, you got to watch that stuff like a hawk.
Great. Along a similar vein, but at the corporate level, what qualities in a leader do you find to be the most important when navigating a bear market? So this speaks to corporate governance. And how are those different from the characteristics you look for in a leader during a bear market, if they are different at all?
No, they're not. They can't be very different. I think in a bear market, we've always said you got to hook your horse to a wagon, or you got to hook your wagon to a bunch of horses. And you got to have confidence in those CEOs that they're the right guys. And so it helps if you know in advance and really understand the business, because it's hard to make new friends in a bear market. And new friends take time to really, I say new friends, new partners for us. It's hard to make them, right? I think that executives, we have a Hall of Fame that we nominate every couple of years someone to go in the Hall of Fame. And if you look down that list, there's some guys who are really steady Eddies, man, like Michael Chan has kept plodding along, was building a better and better business every day. And we had other guys like Paul Chung at Kingboard Chemical Paul was a high beta guy. You know, when you were in Kingboard, you had to be prepared, right? But it's, again, go back, what do you pay and what do you get? We were paying almost nothing for Paul Chung, and he was great value. It's just when you pay a lot for the high beta guy, that's where it gets bad. Or you pay very little for a guy who's not going to grow very aggressively, you know? So you got to kind of figure out where everybody is, and that's where you've got to be engaged. And mostly you can tell what these guys are by looking at their track record. How have they financed their business? How did they set it up? You know, for most of my career, a lot of the executives were people my age, you know, and when I was starting, they were starting and they had no money and I had no money, and, you know, so I kind of know where they came from. But the more insights you can get into how these people are and where they've come from, you'll realize, but you should be open to all types. You just got to watch out, you know, the alpha male guy, or the guy who's done aggressive transactions in the past. If he did it in the past, he's going to do it again. And so first time you're a victim, the second time that was your own fault. You know, fool me once, don't fool me twice. So they're guys we just won't invest with. So that's part of what really makes this the best industry in the world, because you are trying to figure out people and their motivations.
Great, thank you so much. I think we have time for just a couple more questions here, if you can do it, Richard. One question we had was, can you speak a little bit about how your past work in Latin America has impacted your investment approach and what you do, and how has your experience also working with nonprofits there impacted what you do as a firm?
Well, my daughter and I started going down to Honduras as part of a medical mission, because I wanted her to see how the majority of the people on earth live. And so we went down, slept on the floor, all got sick, et cetera, helping really destitute areas of Honduras, rural Honduras. And one of the problems we found down there was the women and children were on nebulizers all the time. And I'm not a doctor. I didn't know what was going on. I just knew a lot of them were on nebulizers. And literally my 12-year-old daughter came back one afternoon, and she'd been taken out into the village, into the homes. And she said, "Dad, I figured out the nebulizers. Come here." And she led me out into a village and went into what we now know is a very typical Honduran home, rectangle sheet, plastic sheet down the middle, living on one side, cooking and eating on the other, with a big open, like an oil drum on top of an adobe circle, with big mouth, with a big log tucked in there, and no, sorry. I didn't know so many people called my mom all the time. It's great. We literally that day, we said, we're going to build better stoves for these people, because the smoke was just killing the women. And it was the smoke that was why they'd had the nebulizers. And so I went to a lady who at the time was the cook for the medical mission, Doña Emilia Mendoza. And I said to Amelia, I said, and I knew, you know, I speak Spanish, so I knew Amelia was really the smartest, most together person. And I said to Amelia, I said, "Amelia, I want to build stoves and I need your help." And Amelia worked with us, and we set it up, and we got a stove, and we started building, and we built a bad stove, and then we built a less bad stove, and then we built a better stove. And we now build the best stove in Central America. We have by far the best stove project in the world. And Doña Emilia and her team have built 245,000 stoves in rural homes in Honduras and Guatemala. Amelia has taught me about life and the importance of life much more than I have to her. Their work, we brought a lot of our business acumen to it. And Doña Amelia was completely on sides to do all this stuff. And we've learned a lot of lessons and do a lot of things right down there now. Having those sorts of experiences changed my life in lots of ways. We have financed the entire 245,000 stoves with carbon credits. And I knew what a carbon credit was before I knew what climate change was. Thankfully, Jeremy Grantham, who's my partner in Honduras, taught me about climate change, and so that was a long time ago, and so we've learned, and that's the way to me, if you ask very philosophically, that's the way we all get rewarded in life. Do a good deed, help somebody, do good stuff, and people are gonna pull the wool back and open your eyes to much greater things. And so the people in Central America really need our help. Brain drain, corrupt governments, they're ignored by everybody economically, don't have a lot of natural resources. They really need help. So I don't know, how does that help me? I don't, I'm a better person for knowing Doña Amelia for sure.
I think it's a great example of how even in an investment management career, you can continue to be a mission-driven person and continue to give back in different ways. So really, really
I'd like to, Rick, I'd like to feel that I was doing the right thing before I met Doña Amelia, but I do a lot more things for the right reasons since my association with her.
Great. Well, once again, appreciate your time. And I just wanted to end with one last question that's more market related. And it's about structuring an organization. Are there any organizational structures or business policies that you've put in place to reduce the emotional aspects of investing, and particularly of getting discouraged during a bear market? Maybe talk a little bit about some of your experience in managing through those crises and what guardrails you could put in place.
Yeah, I'm gonna hang up again. Maybe my mother's got a hot date I don't know about. I don't know. I think you have to create a culture within firms, okay? A lot of people are, super aggressive in this industry, super competitive. And we have a culture at Overlook that says that the enemy is outside, not inside. And we've had that culture, but we've backed it up by, we don't do postmortems, we don't finger point with mistakes. One thing I know in this business, we all make mistakes. And so you have to be mentally prepared for making mistakes. But what firms don't need to do is to point fingers at you when you made a mistake, because you didn't want to make a mistake, but something just went against you, a long tail risk just went against you. So we don't do postmortems. We have a philosophy of moving forward collectively as a group. We'll have open and honest debates where people are happy to expose their views on stocks. And once we own it, we're all in it together. And this is particularly important at times of bear markets. I said, don't ever question the investment philosophy of bear market, but don't also, you need your partners, you need your colleagues to get you through collectively these bear markets. So it's critically important at times of bear markets to have this culture that we're in this together. And we're also, as I said, half Western, half female, half male, we're all this mix, right? We come from all over Asia and all over the world. And that's hard, but boy, when you can get a culture of being in it together and having each other's backs with that diverse culture, then it becomes really self-policing, self-reinforcing. People, we don't hire a lot of new people, but when new people come in, it's a completely foreign environment for them, and it takes them a while to get it. But I think that, you read about Ray Dalio. I think Ray Dalio could not be further could not be further from the way we should run our fund management businesses. He's really, it's just an anathema to me. And let alone that he manages $240 billion and is compounded at 4.5% for the last 15 years. You know, but it's his principles that are wrong. You know, we're all human, you know, and it's important that we treat each other with respect and have humility. And, you know, we say there are no egos. I don't want people flying in private jets and driving around in fancy cars. And, you know, and I lead by example. I drive a 13-year-old car and I live in the same house. I got the same wife, you know, and it's that kind of culture that's really important. And as all of you get older and you begin to set up your fund management businesses, these are issues you've really got to give some quiet time to think about. So.
Great. Well, that's a wonderful way to end the conversation, and really want to thank the members of the UVA community and other friends who joined us for some great questions and spending time. And most of all, thank you, Richard, for spending some time with us. Just really encourage everyone in the audience, if you found this conversation interesting, to pick up a copy of the model, which is available now wherever you order books. And thank you again, Richard, for a great conversation today.